All right, good morning, everyone. How are you today? You ready to get this thing ready, rocking and rolling? Here we go. All right, there you go. You guys should be able to see me just fine. All right, good morning. Forgot to change that. This is Buddy with the Fox with Stocks live show where we talk about learning trading options in a fun, interactive environment. If you guys can hear me just fine, go ahead and type into the live chat room. If you're on the replay, go ahead and comment below. Don't forget to like and subscribe. Monday we talked about setting goals and whether our goals should include cash or whether our real goal is to try and make more stocks, try and get more stocks, acquire more stocks. So is your goal really trying to make more money during this inflationary environment when the US dollar could be taken over by the Chinese yen and or Bitcoin and other cryptocurrencies? Or should our goal be to acquire more stock? The more I've been thinking about this and doing this, the more I want to acquire stocks even without, if you think that the US dollar is going to stay the reserve currency of the world for the next 100 years, still going to have inflation, still going to be a depreciating purchase power with cash, which is why I'm more interested in stocks nowadays. So I'm going to go through the basics of the wheel strategy with you guys today because we haven't done that for a while, and I wanted to make sure that if you're new and maybe you haven't, I've asked you to type in the chat room, the live chat, and ask us or tell us if you're new. Ask us any questions that you might have. But I haven't. Maybe I should just go over it with you. It's always good to go over the basics. So, the wheel strategy is mostly a two-part strategy that involves selling cash-secured put and then selling stock-covered calls if you ever get assigned those stocks. So what we do is we go out and we look for stocks with high enough volatility. I'm just going to change this music. I'm just going to turn it off for now. Okay. What we go out and we do is we look for good companies, but ideally we want them to have enough volatility that we're going to get good premium when selling the option. So that is step one. We go find a good company, and I do emphasize those words, a good company, something that has good fundamental values, something that doesn't have too much debt, that has good earnings, good revenue growth. Those are the things that we're looking for, possibly a disruptor in a market, or at least has a moat and is going to be a company that can continue to grow and survive over the next 1 or 2 years. This is important because we're going to sell a cash-secured put, cash-covered put. You can call it CCP, CSP, same thing, okay? And if the stock goes down enough, then we will be forced to buy it because we are the seller of the cash-secured put. So, for example, we might have a stock that's going for $30 a share, and you might agree that if it goes to $20 a share, then you're going to buy it at $20 a share, even if it was 15 or 17 or 18 or 19 or 19.99. If it's below $20 a share, you will buy. That is what you're agreeing to when you sell a cash-covered put. Now, this is great. This is actually really, really great. It's kind of like putting in a limit order to buy a stock that you want and getting paid every single month until you actually get to exercise your limit order and buy the stock. So if you're waiting for the stock to go down and it just doesn't go down, on a limit order, you're going to make a big fat zero. You're going to make nothing. But if you're selling a cash-secured put, you're going to earn premium every single month until you get to buy for that discounted price. But let's say what happens. Maybe you don't actually really want to hold the stock forever, or you want to keep the wheel going. So now you've been assigned, so now you own 100 shares. You can take those shares and sell a covered call, ideally at or above the price that you were assigned shares at. So for example, we have a $30 stock, you sell the $20 put, maybe you get 25 cents only in premium. Now you own those shares for $19.75. The stock drops to $19.50. You can turn around and write a stock covered call for $20, $21, $22 and earn premium. And if the stock were to rise back up above those strike price, then your shares would get sold and you'd be right back to the beginning of the wheel with cash in hand, ready to sell more cash covered puts. That's why it's the wheel. It goes around and around as you get assigned. But most of the time, I'm going to tell you this, over 70, 80, possibly 90% of the time, depends on the stocks and volatility, depends on your strikes that you choose, okay? You can choose higher risk or lower risk, okay? But most of the time, if you're following my strategy, you will not get assigned. What does that mean? You take that $30 stock, you sell the $20 put, and how often does a $30 stock drop to $20? Not often. So that option is going to expire worthless and you get to keep that 25 cents. Now, you could do the $25 strike and possibly get 50, 60, 70 cents in premium. So you'll get more premium the closer you are to the current price of the stock. But that's going to lower the amount of discount that you get to buy. It's going to increase the risk that you take, but you get to earn more premium. And so you get to pick and choose what is the right distance and safety and what is the right premium and risk for you. Okay? So the wheel is a management strategy. What do I mean by that? Well, if you're looking at it through a lot of options books, you might not see the wheel because it is not a spread. A lot of them will teach you spreads. They'll teach you this is an iron condor, this is a strangle, this is a bull credit spread, etc., etc., etc. And you might not see the wheel in there because it is not a spread. We are not opening multiple legs at the same time. Rather, it is a management strategy. So that means that we're going to sell the cash secured put and we have a plan in place. If the stock goes up, we're going to close early. If the stock goes sideways, we're going to wait for it to expire. I'm going to hold on a second. I see that my screen is loading. Okay, looks like we're good now. So I'm just going to repeat that. We have a plan in place. If the stock goes up, we're going to try and close early. If the stock goes sideways, we're going to let it expire. And if the stock goes down but is above our strike, again, we're going to just wait and let it expire. And if it goes further down, we're going to take possession of those shares and we're going to sell a stock covered call. That's why it's called the wheel, because we have an action that leads back to the beginning and we have a plan and we just repeat it and repeat it and repeat it and we keep earning money every single month. Every single month we're like wheels on a bus going round and round, just making money, making money, making money, okay? How do you fail with the wheel? You skip your fundamental research, you pick bad companies, you panic, and you sell too soon instead of waiting for the option to expire. You take on too much risk by making the position size too big, and you're just lazy. You don't do enough research, so maybe you take on too much sector risk or you don't balance yourself out between other sectors. Okay? Why do I like this versus, say, day trading? Because day trading is a job. Day trading takes way too much time. And time is the opposite of freedom. I'm all about freedom. And money is very important to freedom, but so is my time. And so I want a strategy that works and gives me lots of money and lots of time. And day trading takes away your time and gives you money, and you have to be really good at it. In fact, there's a common saying called the 90-90-90. 90% of day traders lose 90% of their portfolio in the first 90 days. So again, why do we use this? Because this is a strategy that is very high probability. It's something that you can do over the weekend, put in your trades on Monday. You can free up a lot of your time with this strategy versus day trading. It's just going to suck away a ton of your time. To day trade properly, you have to be at the computer. And if you're starting, you really should be at the computer 10, 12 hours a day when day trading, okay? So that's why we do the wheel. It's very convenient. It's low time commitment. It's very repeatable. I want a strategy that works over and over and over again. Cryptocurrencies are constantly changing. You have to constantly go find out what's working, what's new, what's DeFi, this. Okay, I want something that's very repeatable that I can do for a number of years, and my strategy doesn't have to change very much. Okay. Other thing, compound growth. 2 to 5% monthly yields are amazing returns when you're compounding it. Even if you just do what I consider very safe, 2%, 2%, 2%, 2%. Well, that's already 24% in a year. But when you add compound interest to that, it's going to be closer to 28, 29, 30%. I forget what it is exactly. But if you can get to that magic number of 5%, and that's risky. Right now, that's right on the edge because you really have to be choosing the right strikes and the right companies, and it's hard to do that. But last year, at 5% compounded monthly, you can get up to 80%. I was able to get 70% since COVID. About June is when I started doing that, okay? It is very possible to do it, but that 5% is right at the edge. I think you can really get between 2 and 5% using the wheel in today's market, okay? The next best thing is downside protection. I already talked about it a little bit with the cash secured put, but I'm going to say you get tons of downside protection and you get to build that in and choose your target. I personally do not make many trades, maybe a couple, that have 10% downside protection, but I'm really looking for 15, 20, even 25% downside protection. And what I mean by that is if the stock drops 20%, you don't lose any money until that point. You start losing money after that point. I've got another great slide. I don't have it here for you today right now, but basically, if you look at it, when you lose, say you have $100, you lose 1 to 10%. If you were to make that back, it's basically the amount you lost plus 1. It's almost a 1-to-1 relationship. It's a 1 to 1.1 relationship, okay? If you make 1 more percent than the amount that you lost, you will make that money back. Think about it. Take $100, you're going to go ahead and lose 10% of that, puts you at $90. Well, guess what? If you get 11% return, you'll be right back to where you were before. But that's where the 1-to-1 relationship ends. After that, it goes exponential or superlinear. I'm not sure which one it is. I think it's superlinear is actually the correct term. But if you lose 90%, okay, well, let's not be too dramatic. If you lose 50%, okay, how much does the stock need to go up for you to break even? It needs to go up 100%. That's insane. It has to go up 100%. It's very hard to do. When a stock loses 50%, unless it's already a volatile stock like Tesla or Bitcoin or something, it's going to be very, very hard to climb back up there. But if you had 20% downside protection, think about this. If you had 20% downside protection, a 50% drop is still going to be absolutely brutal, but effectively you've only lost 30%. That's going to be much more manageable. If a stock were to drop, say, 30%, that's going to be absolutely brutal for the buy and hold investor. But with you've got 20% downside protection built in. That means you've only really lost 10%. You're back to that 1-to-1 relationship. And if you turn around and sell stock covered calls, you can, I'm trying to be textbook here, but it also takes some realistic scenarios in here as well. I can probably get about 2 to 3% on my stock covered calls. So if I lost 10%, after selling a cash secured put, it would probably take me about 3 months to break even just by selling the stock covered calls. And then you can watch the stock appreciate and then let it get sold away. You can actually make more money if you've ever get assigned on a cash secured put, as long as you're in a good company that does rebound. But it's so much safer. I want to get this point across. It is way, way, way safer than simply buying the stock and waiting for it to go up. Because when you buy a stock, you have how much downside protection? You have 0. I'm looking at every once in a while I'm just seeing the wheel go on my screen here. Let me know in the live chat. I got a couple people watching. Are you seeing a lot of stuttering? Is it freezing? What's going on with the video and the audio? I want to make sure you guys can hear me. Not that there's much I can do about it right now. I think we might be dealing with some island internet issues, but let me know if I need to slow down and pause when I see that wheel going, or if you guys can hear me just fine. Just go ahead and type that in the live chat, whether or not you're seeing a lot of audio problems or anything like that. Okay, excuse me. Now I really wanted to hammer home that last point. That's why we spent so much time on it. The next is
Okay, can you guys hear me now? I do not know. I actually have no idea, but I just saw that the microphone readout was not bouncing anymore. Okay. Where did it cut out? Because I just looked over and I saw that there was no. I got a little yellow line telling me when the sound is going, and suddenly it just stopped. I just looked over and it wasn't moving. So I have no idea where you guys lost my audio. What was the last thing you guys heard me say? And thank you, Oscar. Appreciate you typing into the live chat. 1 minute ago. Okay. I apologize for all these technical difficulties today, guys. All right. So I'm going to try and go back. I don't know where exactly a minute is. Okay. But we're going to talk about space stock now. We're going to use this as our example. Okay. So anyway, let's go back to this. I know what you guys might have missed, so let me just say, because this is important. You might be asking yourself, Bud, how do I sell something I don't own yet? I don't own the stock. How can I sell a put against the stock? Am I going short the stock? And the answer is no, 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 no. Okay? What you're doing is you're writing insurance. Just like if you were to go get car insurance, the guy selling you car insurance doesn't have to sell you the car. He's just selling you insurance in case anything happens to the car. So that's what we're doing. We're effectively saying, hey, Mr. Buyer, Mr. Guy who owns some stock, I will sell you insurance so that if your stock goes down, I will step in and buy those shares away from you at an agreed upon price. Now, we're only going to do this for an agreed upon time. And guess what? I actually get to choose, as the seller, I get to choose the stock, the strike price, and the expiration. And then the broker will match me with a willing buyer. Okay? So I'm not having to just insure anything that I don't want to insure. I'm literally choosing the stock and everything else that I want to insure. Sorry. Anyway, dealing with so much stuff. So you get to choose what you're going to insure and what strike price, and depending upon the time and the strike price is how much premium you're going to be able to get out of it. Okay. So we're going to use space as an example, and space is now above $30 a share. So this kind of works, but this is an old one, just bear with me. But with the stock price of space being $30, okay, you could sell, what did I say call? It should be put. Anyway, let's going to move forward. Bloody heck. All right. Not going as smoothly as I wanted it to tonight, let me tell you. I've already had a rough, stressful last couple of days. So, it could be going for $30 a share. If you were to go out and find this put, you could see that the $27 strike could collect $1.65. That was the last price that it would trade for. So you'd have $3 of downside protection, plus you would get an extra $1.65 in downside protection and premium. So I want to run you through what happens in different scenarios, okay? What if you just bought and hold $100 shares at $30 a piece? What if you sold the $26 put? And what if you sold a cash covered put? Same thing. It's been a while since I've done these slides. So, scenario A, it goes up $3 to $33. If you were to buy and hold, you'd make 10%, you'd make $300, okay? As the option seller, we'll make about $130 if we sold the $26 put. Let me update these slides. Option B, what if it just went sideways? It didn't go up. Maybe it went up to 31 and then it came back down to 30. We still call that sideways after 30 days. Well, if you just bought and held the shares, you would make a big fat zero. That's not a big deal if you think the company's going to go up in the long run, but for 30 days you made nothing. Whereas if you had sold that $26 put, you would have made $130. Now this is where it really starts to get interesting. What if it went from $30 down to $27? Well, Mr. Buy and Hold guy, he's going to lose $300 for risking his money and buying those shares for 30 days. That's not very good. But guess what? It's $27 a share now. It's still above our $26 put. That means that we're still going to keep all of our premium. We're going to keep the full $130. Now, scenario D, it drops 15%. This is going to be bad for both of us, but look at the difference. Look at the difference between these two guys. If you were to buy and hold those shares, you're going to lose $450. If you did the cash secured put and then immediately liquidated it once you got those shares, you're still going to make $80. So you don't make the $130, you lost $50 of opportunity value, but you still made $80 even though the stock went down, and it went down a lot in this scenario. It went down $4.50 off of $30. Okay, that's a big move, and yet we still make money. That's why I love this strategy. We make money in option A, scenario A, scenario B, scenario C, and even scenario D. Next, scenario E. It drops down to $24 a share. The buy and hold guy just lost $600. How much do we lose? We only lose $70. Why? But Bud, you might say, Bud, I'm confused. We sold the $26 put. You just told me it went down to $24. Don't I lose $200? No. Remember, you get to keep the $130 in premium. In fact, you get that in the very beginning. You can spend that do whatever you want with it right away. Okay? Which means that you lost $200 on one hand, but you made $130 in the other hand, so you've only lost $70. But this is where it actually gets great. You get to keep the shares. You get to keep the 100 shares per contract. You only lost $70 a piece, but guess what? That's a lot better than buying at $30 a piece. You'd be down $600. Now you just needed to go up 70 cents, and you're going to break even. The other guy needs it to go up $6 whole. Okay? Now let's say that happened. Let's say it went up $6. He's going to break even. What's going to happen to you? You're going to make $600. Okay, you guys see how powerful this is? And this actually happens. I want to point out this is not like some far-fetched fantasy that never happens, like winning the lottery ticket. If you pick good companies and you do these cash secured puts over and over again, you will eventually get assigned a company. You'll get the shares, and then you'll watch it skyrocket in price. I've done it with InnoData and CleanSpark. CleanSpark, I got assigned for, I forget if it was 8 or 9. It was such a great company. I didn't see any negative news or any reason why it would go down. Guess what? In 3 months, it jumped back up to $27, $30. I was able to sell for 300% profit instead of 15% profit using the wheel. All right? And then, terrible scenario, it goes down from $30 down to $22.50. Buy and hold guy's going to lose $750. We're also going to lose a bunch of money. But look at the difference again. He's losing $750. We're losing $220. Which one of these do you want to be? And again, if it goes back up, as soon as it goes back up $2.20, you're going to start making money. He needs it to go back up $7.50. And these, by the way, this $26 put, $1.30 premium, this break even, this was a real scenario at the time. This is old data, but this was very, very real. Okay? So how do you do this? We've only got about 28 minutes before the market opens, so I'm going to run you through an example if you actually wanted to put on a trade like this in Tastyworks. I use Tastyworks. I recommend it. We've got a referral link down below. We get some points for the referrals. It's not a big deal, okay? But I'm going to run you through it because I want to show you how easy it is to do. You go and you type in the symbol, top left here, SPCE, and then it's going to have a bunch of dates. And you choose one that's about 30 days out. Then you go out and you find your strike price. Here was the 26 that we did way back when I made these slides. You can see here, this is the bid and the ask. It was between 99 cents and $1.51. Comes out to about $1.30 in the middle. Okay. You can set whatever value you want. So you don't want to go above $1.51 because you're probably not going to get assigned. And you don't want to go below 99 cents because there's already people ready to buy it for 99 cents. So you want to pick a number that you think you can get between 99 cents and $1.51. In this example, we put it about $1.30, about $1.34, okay? You just type it in down here. Then when you're ready, you hit review and send, and it's going to come. One more thing. If you want to check this out, top left you can hit curve, and it will show you the breakdown. It says, hey, from this price to here, you're going to make pure profit in the green. This gray zone, you're going to lose money, but you're within your break-even period. But you might have to buy the shares. You haven't actually lost any money. And then this red zone here, it's showing you, hey, this is where you start to lose money, and this is how much money you can lose. Okay, so this is not it's a great trade. Anyway, good information. After you hit that review and send, you're going to see a confirmation window like this. And you'll see here, it's giving me $134 credit for putting on this trade. That's because it was $1.34, okay, times 100 shares, so it's $134 in credit. Now, that's real credit. I get to take that and use it right away. So you'll see that my max loss and my buying power effect is different. Part of this is margin, and part of this is being built in that they're giving me that $134 in credit, so they don't have to lock up the full amount here. If I were to get signed at 26, okay, the way to think about this, sorry, so there's a $26 strike. You would think that the max loss would be $2,600, but it's discounting my credit, which also gets rolled into the buying power effect, because you're getting the credit up front, and it's yours to keep no matter what. Okay? Hope that was super clear that time. And very important, I think you need to know how to cancel a trade if you made anything wrong or if you change your mind. You simply click on the Activity tab on the left-hand side. You find the trade, you right-click it, and you hit Cancel Order. That's it. It's as easy as that. And look at this. Okay? Did you have to go out and find buyers and sellers? Did you have to go out and market your company and your brand and the idea of selling insurance? Did you have to start a company and file for... No. You sign up for a broker. You sit down on your computer. You don't got to talk to anybody. You make a few clicks. You click on the date. You click on the bid on the strike price that you want here. You type in the numbers that you want. You hit review and send. You check the confirmation. You make sure it's right. And then bada boom, bada bing, you've got a trade online that's ready to go. Now, of course, I'm skipping the research of it, but I just want to point out how much easier is this than running a business and trying to find customers. You have willing customers already right here. It's literally telling you customers are ready to buy. They have an open order. They're ready to buy right now at 99 cents. And you have sellers ready to sell. They have open orders to sell at $1.51. So if you sell at 99 cents to $1.51, you'll find some buyers. It's literally telling you that, okay? Super, super easy stuff. We've got some referral links and things down below. We've got a tip jar. If this helps you make some money, you guys can give back. We appreciate that. If you guys haven't signed up for Tastyworks yet, it's my favorite program. Okay, I really don't make much from that referral link, but I do appreciate you if you use it. Maybe if I get 1,000 people to follow the referral link, I'll get a Tesla car. But it's really just about giving you guys the right tools. Okay, Robinhood. I'll tell you, I don't use Robinhood. They've had too many problems. I would never use Robinhood basically at this point. I've used Schwab. I've used Thinkorswim. It's just so much easier to set up your trades, to find the trades, and to roll the trades inside this versus use software that I've used. Okay, that's why I recommend it. Okay, let's talk about some other stuff in there. Hey, one of the things that does really help us out and can be of high value to you guys is go check out theoptionsoracle.com. Looks like my internet might be bad again there, might be losing the sound, but hey, if you guys can hear me, go check out theoptionsoracle.com. They have a monthly newsletter. It comes out Sunday at 2 p.m. after the monthly, too close to the money. So this thing is actually going to go out and it's going to find the right cost basis or break-even percentage, depending upon what terminology you use, to make sure you're far enough out of the money that you're going to have a good probability of profit. And it's saying, just an example, you could actually do this trade if you want to. Riot is a Bitcoin mining company. Okay, so is Mara down below. It's currently trading at $32.23. If you were to sell the $30.50 put, you would collect $3.15 in bid in profit. Okay, and you would that would be a 10.33% ROI in 30 days, as long as it expires, as long as it stays above this $30.50. Now that's a bit tight. Let's see if we can open up some more of these. Okay, my internet's working for this, it looks like. Mara is actually, I think, the better company. a lot of people have done the research on it, have figured out that Mara is a better company. It's going to have better profits and better exposure to Bitcoin. Riot, the thing I like about Riot is that they are involved in some accounting stuff and some Bitcoin custodial services. So they have other services besides just mining Bitcoin. So I really do like both companies, but Mara is supposed to be the quote-unquote better one. Okay, I thought I clicked on Mara, but it brought up Space there. Anyway, if you were to sell, well, we were already talking about Space today. Space is now trading at 39.42 cents a share. Remember back in the day, we were doing $30 call puts on this as credit puts, cash secured puts. I'm super flustered and frustrated today. You can already, if you wanted to, sell the $37 put on this. You collect $3.50 per share up front, and as long as that expires, you would collect $9.46% ROI in 30 days. Now, I'm not going to recommend you go and do that because Richard Branson is going to be on a test flight, which is scheduled for July 4th, and if anything goes wrong, we're going to lose a founder, and we're going to have a major, major setback on the stock price and that company. So I would not do that. So the risk to me just isn't there, right? It's way too much risk for just a 10% return. You'd actually be better off with a real strangle on this company. But just showing you how my scanner works. All right, now we've got Mara. I want to come down and I want to find a cost basis distance that's greater. Now your scanner might not have this option, but instead of selling the 27 or the 26, you could come down and sell the $23 put, currently trading at $27.34. You would get $1.20 in profit, and as long as that expires, and it would have to drop $4.34 for it to get assigned to you. As long as that expires, you're going to get 5.22%, 5.22% in 23 days. That's actually about 80% APR if you're able to repeat that month after month for a year. I might not even upload this thing. I'm so frustrated with this video tonight. CleanSpark, that's the company I talked about. Dropped down to 8, got assigned to me, then jumped up to 27. Problem with CleanSpark now is it's just a worse version of Mara and Riot. So if I want to do a Bitcoin trade, and I'm going to do it on those, I'm not going to do it on CleanSpark. But that's what they're doing now. They're mining Bitcoin, which is why they jumped from 8 to 27, but also why they've come down again. Stop. I guess since this is already saying I'm not connected, I should just reload it. Did it work? Okay. It looks like I'm back online. Of course, I don't think I have any viewers right now, though. I don't blame you guys for leaving. This has been super frustrating, but hey, at least we're back, it looks like. Anyway, we continue on with this. Show must go on, as they say. We've got 4 minutes before the opening bell. Very frustrating 2 days. I'm now having a very frustrating recording session with this internet issue. Now we've got 3 minutes before the opening bell. Then we can manage these shares.
Rite Aid, that company's having major problems. Kodak continues to bounce between 7 and 9. Let's see what Tilray's been doing. Had a Tilray trade. I think we got out of it eventually, but this stock did not do as good as I was hoping it would perform. Bed Bath & Beyond, I did the research on that, has way too much debt and negative revenue quarter over quarter. Not going to touch that. Clean Spark is just another Bitcoin mining company. Sol is solar panels. Mara and Riot, also Bitcoin companies, but the better ones, better than at least than, what was I saying? Than Clean Spark. Space, you see that you can get 9% in 30 days on Space and be $2 out of the money. However, I'm not going to recommend that. Richard Branson is going to jump on a test flight instead of waiting for the public flights so that he can beat Jeff Bezos to space. He's going to be doing that on July 4th, thereabouts. Could always get delayed for weather. Okay? And the reason I'm not going to recommend trying to make 10% in 30 days is if anything happens to that shuttle, we're going to lose the founder. And it's going to be a major setback for the company. The stock price is going to plummet. You don't want to try and make 10% on such a volatile, any direction catalyst event like that. You'd actually be better off with a strangle if you can afford the prices on it. You might just do a regular strangle by shorting it and buying stock rather than using calls and puts. I'm sure the price is already sky high with the implied volatility like that. AMC, hey, if you want to be in the meme game, you get $8 out of the money and get an 18% return in 23 days, getting $9.20 in the bid. I'm not going to touch anything like that. Doesn't fit any of my strategies. Triple D, actually, that's a company I was looking at several times. I want to see the price action on that. I have no idea if that was higher or lower than where I looked at it before. Hey, that's the opening bell. Give me a second here. And then I will jump over to that. So it looked like it was high, and then it came back down. I think I was looking at it in this range, so it's right back to the similar price. Anyway, market's open. Let's go manage our positions. And then I am going to sign out early because we're just going to run into technical issues again anyway, and I'm just stressed out. But hey, thank you guys for sticking with this. I see that some of you did come back after the blackout there. I was actually still recording. What am I looking at? There we go. I was still recording, even with it not live anymore, so I'll probably upload the replay of that. All right, ARCG, I've sold a covered call against that at 89.21. By the way, I found out through Facebook why it sometimes has this 0.21 or any decimals on these strikes. It's because the company gives out a special dividend, so they don't normally have a dividend, and I guess to make up for it, they build the dividend into the strike price. I don't fully understand why they do that, other than the payback or include the dividend into it. But it seems silly, but it's a thing. So I sold the covered call on that. I sold it for $1. It's been moving up. Now it's $1.85. I don't want to buy it back. I'll just let that expire or let it get called away, I think. Anyway, BNGO. We've sold a bunch of puts on that, 5, 6, and 7. Those are all expiring on July 16th. I could close this one early for about 90% of the profit, and I've got 23 days left on it, so I'm actually going to go ahead and do that. It might not go through because it's actually between 6 and 9 cents, but if that goes through, then we're good. Anytime you can get 90% of the max profit. What happened there? I do not have enough buying power to make that trade. Okay, I gotta figure out what happened in that. Anyway, when I can, I'm gonna close that early, because if you can get 90% of your max profit, especially 23 days out, you definitely should do that. Here, not quite as much. Here, again, not quite as much. These are newer. That was 30 days ago when we started that one. CLF is an iron mining company. I really like having different sectors, so I'm glad I have this in my portfolio right now, or at least have it operational. This is already down 40 cents, not 40 cents, 34 cents. So more than half in 2 days. I should close that. I kind of just want to keep that going though, because I don't mind if I really don't mind if I get assigned the shares there, because I want to have some shares in commodities, and iron mining is a big one of those. Disney, I sold it for $5.60. It's down to $3.10. I could close that early. It's got 58 days left on it. That is very tempting. I probably should. All right, Fubo, $25 put. Fubo's been doing fantastic. I definitely should close that early. More than 50% in 2 days on that. I'll probably close that tomorrow. Famous last words, right? GRWG, just holding on to the shares. That one didn't go the way I wanted it to. InnoData, I got those for $3 after it got assigned to me. It's such a great company. I never sold any covered calls on it. There's Kodak. I can start a covered call on that, so I'm going to do that. Earnings come out August 20th, so instead of doing the 23-day, I'm going to go 2 more weeks out and lock those in. This bid-ask spread is crazy. I'm going to have to turn on the last to see what the real prices are. Dollar at the money, $1.08 was the last one at $9.50. Good job on that guy. And if I can get $1.08 at $9.50, that's nine. It's only 50 cents more. Anyway, if I can get $1.08, if I get $1 on it, I'll do it for sure. No. Okay. There, we're selling the covered call. $1, wrong account. There we go. Now we're seeing the credit. Almost had that go through on the wrong account. Here's Mara. I own 300 shares and I'm not selling the covered calls. I'm just selling more puts against it. Glad to see Mara's back up again today. Hey, Mr. Guy. Happy to see you. Been a rough day for me today. Not in stocks, I'm just stressed out, and then had a lot of technical issues and internet issues. Had a total blackout on the YouTube channel there for a bit. Plantronics just did not go my way, and then I sold the covered call. That's going to get taken out. That's going to be at or above my break even, so I'll just let that happen. I should have known that was going to bounce back. Wow, Space is at $40.70 a share now. I sold a bunch of these. I had 800 shares. I sold them at 24, when Richard Branson sold his at 26. I knew they would drop. They dropped down to 18. I just didn't have the conviction for the stock anymore after Richard Branson sold a bunch of his. But I did sell a bunch of puts, 23.50. I can close that early, which I will absolutely close that early, ahead of the test flight July 4th, which Richard Branson is strapping himself into. Oh, there's a big spread on this. It's 10 cents to 30 cents. It's not going to get a sign. That's not going to go through. It's telling me I already have a closing order on this, but that's not true. What on earth is it talking about? I do not have a closing order for space. I'm literally looking at it. Am I not? Oh no, I had working turned off. Okay, there we go. Yeah, we definitely want to close that one early, since that would normally be going through after the July 4th event. Let that one sit there for a bit. Tesla's up $20. That's great. Finally, we broke out of the 620 range. Been going between 590 and 620 for a while now. Hey, looks like we're green across the board. Always a little bit of a feel good there when you've got open positions already. Why is my orange? Did I get assigned on these recently? Is that what happened on Rigel? We sold the $5 call and then we bought to close it back for a penny. Alright, so we'll just do that again. Not buy to open, sell to open. My head is just out of it today. Did I get assigned on NBEV? I bought 250 call. That's a buy to close, okay. Why did I have the issue on the buying power? Anyway, let's go through this again real quick. Alright, basically I just went through, looked at my stocks, see which ones are doing the best, or my options I should say, and could be closed early. I don't think we found anything that we really have to worry about. Do keep in mind if you've got anything outstanding on Space, they have a major catalyst event coming out on July 4th, so if you have anything that's going through that, I think, especially if you have any cash secured puts on Space, I think now with it being up $1.44, up in the 40.86 range, now would be a good time to consider closing those out. I'm looking at closing out my 23 and my 21. 27 is still relatively new. I probably should consider closing that one out. Yeah, let's go ahead. Let's go ahead and close that out too. Now the spread is too big. Never mind. 54 cents to $1.21. I'm not going to close it if it's $1.21. I definitely would close it if it got 54 cents on it. Alright, last minute going there. I don't blame you if you don't like and don't subscribe today. This has been a shitty episode. Lots of stress and lots of technical issues today. But hey, I try and do this for you guys so you guys can make some money, learn how to do this. Gave you guys the whole spiel of cash secured puts, the quick version with the slides and everything today. Most of that seemed like it went through okay. If you guys enjoy this and if you find value in it, do be sure to share it with your friends. Don't just hit like and subscribe. Sharing it with your friends is the most important thing now. And do check out theoptionsoracle.com. They give a great newsletter every single month. I've been using for about a year. I did put on all of their recommendations from this weekend, so I look forward to making money on that. Anyway, guys, I am wrapping up and getting out of here. I want to thank you guys for being a part of this. I apologize for the technical issues. It's just part of living on an island, and I hope that you guys can have the freedom to live wherever you guys want and not have to work full time and enjoy the most out of life. Thank you guys and good night.